Hi, Brendan McCarthy, Certified Financial Planner with Boulevard Wealth Management here in Eden Prairie. I wanted to record this video to talk about a question I'm getting a lot from clients right now. With tax season approaching us, I'm getting the question of how can I reduce my taxable income or my tax bill next year and in future years. The first thing to know is that if you're single earning more than 140,000 a year or married earning 214,000 or more, jointly, a lot of the tax breaks that are offered through the U.S. tax code are no longer available to you. So what I wanted to talk about is ways that you can still reduce your taxable income, even if you are above this threshold. So the first way, and easiest way, with a click of a button, you can go in your 401k and up those contributions. You can put up to 20,500 into that. If you're over 50, you can put even an additional 6,000 into it. That's an easy way to reduce your AGI, your adjusted gross income, and then thus your taxable income as well. The other thing I wanted to mention is if you're looking for these tax shelter methods, make sure that you're putting it into the pre-tax 401k and not the Roth. That will give you the tax deduction today as opposed to in the future. So if you're a business owner or a 1099 employee, I don't have time to get into all the details here, but you have even more flexibility and can get up to, I believe the number is $58,000 a year is a tax write-off into your 401k. But there are some pitfalls and reasons why it may not make sense for you, even if you are a 1099 or business owner. But come talk to me if you have questions on that. The second thing is max out your HSA. And this is a no-brainer. There's the maximum contribution's not that high. It's at $3,650 for single or $7,300 for a family plan. But it's the best tax vehicle offered through the U.S. tax code. So you get a tax deduction to put money in that will reduce your income, and you can access those funds and pay for qualified medical expenses on a tax-free basis. So again, like I said, no-brainer, max that out if you have the ability to. The third is a little bit more ambiguous, but it's important to talk about because it could be vastly the most impactful change that you could make, which is changing your compensation structure. So if it's not available to the vast majority of Americans, but if you do work for a publicly traded company, exploring potentially negotiating your contract or your employee-employer relationship with them may make a lot of sense, especially if you're higher income. So think about this. The highest taxed income is salary and bonus. If there's a way to earn income that is not salary or bonus, you're going to save a lot in taxes. So those incomes, you have to pay Social Security taxes, Medicare, and ordinary income. All three of them are high tax rates. The best way to do that, think stock options or equity compensation. So by getting compensation in stock, now you're opening yourself up to a little bit more risk. So understand that you could earn more or less based on the stock price, but you're not going to put yourself in front of the Medicare tax, Social Security tax, and you have the ability, as long as you hold on for over a year, to get preferential long-term capital gains tax rates, which is unbeatable, the best tax rates offered through the U.S. tax code. So explore those options. Think about maybe specifically RSUs, restricted stock units, non-qualified stock options, incentive stock options, or even employee stock purchase plans, which are offered to pretty much everybody that's employed by a publicly traded company. Those are great ways to reduce your tax bill and looking forward to kind of reduce your taxable income as much as possible. Let me know what questions you have. I'd love to hear them and hope to talk soon.